and welcome to the Build and Exit podcast. I'm Julie Wilkinson and I'm your host. I'm the owner and founder of Wilkinson Accounting Solutions, and I started the podcast at the back of the work we do in acquisitions because I realised there was a gap in financial understanding across business owners and investors. So I'm excited today to have Kemi Egan with me. Hi, Kemi.
Hi, Julie. How you going?
Yeah, good, thank you. A bit of an intro. Kemi's massively involved in M&A. She's done 30 M&A transactions in the last 5 years, has had 10 exits, and is also a best-selling author of the book, The Power of Real Estate Investing. So I definitely think, for people looking at selling and buying businesses, Kemi's going to be able to bring some real good insights into things to look out for. And we have some very dishy subjects that we're going to talk about as well, including fraudulent pension schemes of all things. So first of all, I just want to hand over to you, Kemi, and say thanks for coming on, and what made you want to come on the podcast?
Oh, very much my pleasure. Thank you for having me. What made me want to come on? So obviously been following you and your work for a while, and particularly your posts on LinkedIn, I think are really poignant about understanding balance sheets, understanding finance. A lot of people, including myself for years, just like, oh, it's not my circus. I don't know. I don't need to know. Someone else will know. And actually, when you're running your business and you're the one signing off your accounts, you're the one taking responsibility for the stuff that's there, you're the one that's saying this is true, this is accurate. And can we realistically do that if we don't know what it's including? And I think all of those things that can be done to help support and educate people is really important. It helps protect them for lots of reasons that we're going to go into today, and to the way that you do it so approachable and non-judgmental. I think it makes it less scary. So I really wanted to kind of come on and hopefully add a little bit of value of support anyone listening through the journey.
Yeah, definitely. No, well, you're going to do that. And with your background anyway, I mean, obviously our listeners are typically investors, buyers and business owners that want to sort of maximise their own value on exit, really, because it's a bit of a shame, really. A lot of people spend years building these businesses and then don't get a lot for them. So I feel like this is what this podcast is bringing to people. It's helping people not only acquire, but also maximise their hard work, really, I suppose, in the end. So I just want to go a bit into the background, really, because obviously 30 M&A transactions in 5 years is a lot. And I think, probably something a lot of people aspire to. So maybe you could just give us a bit of an overview about sort of how you got into that industries and then how you managed your 10 exits, really.
Yeah, for sure. So I was a physio by trade. So back in the day when I did kind of the uni thing, I opened my own physio practice. And everything I've done typically has been quite unconventional. A lot of people said, oh, you need to go do your rotation, you need to go into the NHS, you need to do this. I just thought, I just don't want to, actually. What I loved and what I wanted to be good at was a specific type of physio. They don't even really do a lot of that in the NHS. So I went and I opened my business. And I thought, well, that's it, job done. Done the hard work, it's nice and pretty, I've done the refurb, what can go wrong? Turns out quite a lot. We had a huge amount of our clients were from insurance. So, if you have a car accident or something happens, you get sent for physio. And it turns out, paid really badly. So over a period of time, I kind of got used to this, and it got worse and worse. From one particular company, it got worse and worse and worse. But I thought, oh, it's okay, they'll pay, it'll get there. And they didn't. And this company went under, owing us an incredible amount of money for such a small business as well. It was bad. I was out of money, as what I call the founder's curse. I hadn't been paying myself and paying left, right, and centre, and I couldn't afford. I had to make a choice between whether I retained the physio clinic or whether I paid my rent. I couldn't do both. There just wasn't enough money, so I gave up my home and moved into the practice. Because, as most business owners know, if you've been in trouble, you've got PGs attached to you, you've got liabilities attached to you. Even if I shut the doors, I was still going to be hounded for tens of thousands of pounds of debt, and I needed to turn it around. So rolled up my sleeves, dug in, read everything I could, studied everything I could, Googled everything I could, and over a period of time, managed to turn it around. Grew the business to a couple of sites, and someone came along and said, oh, would you consider selling this? I've got some. Would you exit? I said, no, of course not. It's my baby. What else would I do? I love this thing. I said, you sure? I said, no, I'm very sure, but thank you for the offer. Anyway, still grinding away, working as hard as I can, all the hours God sends, because you're the founder, right? So 8 a.m. to 8 p.m. I was with clients. After 8 p.m. I was sorting out the cleaning, sorting out the towels, sorting out this. It was a lot. He came back. Would you consider exit? I said, I don't think so. I don't know what else I would do. Anyway, he made me an offer. And it turned out that it wasn't my baby after all, and it grew up and left home. So I kind of accidentally grew and exited my physio business. Moved into property investing, which was, it was fine, and it is what it is, and it's still a passion, but I didn't love it. I couldn't ever. I loved what it did to my life. I loved, the income. I loved those things, but I couldn't ever get truly excited by it. Suffered burnout, and I took a couple of years off. Went to stay in the Algarve and just hung out. When I was thinking about what I wanted to do when I came back, I was trying to think about the things that I'd loved, the things that I'd enjoyed, the things that I'd been really excited by. And it was the operational side of the physio. It was the making property investing into a business and how you structure things and what team members you put in, and how you make sure you get round pegs and round holes. So that took me to, actually, maybe it's some kind of operational thing. And a business partner and I, at the time, or a friend and I at the time, said, actually, what if we start looking at buying some businesses and kind of adding some value? So that's what happened. We decided, with what we knew and what was kind of the easy thing to do, was to buy some property management businesses. In the end, I think there were 12 or 14 that we got all together, made a group. And the wonderful thing about M&A, when you do kind of roll-ups and group structures like this, is that every business you add on, you can strip out a chunk of the costs. So, you don't need 2 FDs, you don't need 2 COOs, you don't need all of the duplication, all the usual stuff. You just don't need 2 of. So, the first business we bought had a wonderful customer list, but not a lot of stock. The second business we bought had a huge amount of stock. That was a multi-million-pound turnover business, but it had no management team. The third business, I think I'm right, was had the management team and had the structures, but not great stock. So everything we were buying was really strategic to kind of add and build together. So we built this really nice group, stripped out the cost, made it really quite profitable very, very quickly. And then I exited it I think it was about 18 months later, maybe a bit shorter than that. So relatively quick turnaround to go from nothing, no properties under management, to I think we got to over 1,500, well over 5 million revenue, really profitable, tidy group of businesses. Left that and then thought, well, that was a lot of fun. Let's go do that again. So that's how I kind of fell into M&A. It was less about the title, more about the things I thought I could add value to, the things that I was good at, and the things that I enjoyed kind of coming together, which was fun.
Yeah, and it's quite an amazing journey. And if we just go back to that, it was physio, wasn't it? The business that you said at the beginning, the fact that you had these money owed and actually left your home and then stayed in the premises of the business. I mean, I think that's just a big call out to people, like how hard business is. There's a lot of these gurus, or you can grow overnight, you can go to 6 figures. To be honest, I've been in the same position. I've had money owed to me. We've done an acquisition, we've had to manage our cash flow. I think every small business has ups and downs in there, and I do think it's people that you've got to just keep the fight and have the visibility, really, I think, of the business, so that you can make decisions, to keep it, to then grow it to where you want it to be effectively. And you've obviously done that successfully. The fact that in the end you managed to then grow that to then sell it to someone that wanted to buy it. So, that's a really good achievement. So well done for that.
Thank you. But you're right. I think it's, I thought at the time it was only me, but I call it the founder's curse now. I think everyone goes through this. Everyone, or most people that kind of go into this, have the same challenges, and they have the same things to figure out. And, it's tough. It's tough, especially when you're new to it and you don't have a board of advisors and you don't have people that you can kind of call on. So yeah, for young or new entrepreneurs, it's a really tricky phase.
Yeah, and I think everybody's got their own skill, haven't they? I'm good at finances. I was good at my cash flows. So that probably gave me a good starting point, because I was good at tracking, which is one thing a lot of people don't do. But, I had other areas of weaknesses, like, I wasn't good at sales and marketing. My first year, I invested £15,000 in professional development, sales and marketing, LinkedIn coaching, just training, because that was the area of my weakness. That wasn't my background. So I think we all just have to accept our strengths and invest in where we can grow, really, to build up to where we want to be. So one thing I know we've talked about, so I'm quite excited to get into it, actually, because I want to hear the nitty gritty. I know in one of these businesses, I don't know whether it's part of the group or a standalone business, you've had a bit of a fraudulent activity that you found post-acquisition. So I know this is quite a nitty-gritty story, so maybe we could touch on that a little bit about kind of what's happened, really, what you've identified.
Yeah, for sure. So a standalone business was outside the group. I bought it in 21. It was 21, actually. Pretty bog standard, did diligence. It's a, let's call it construction adjacent, like a service attached to that. Not very interesting. Also, with all these businesses, they're boring, kind of boring businesses. Went through diligence, not a problem. Completed on the business, not a problem. The transaction was a bit more stressful than general. The seller was fairly highly strung, and there was a lot of quirks that you don't generally see, but it wasn't enough to kind of raise any flags in particular. They put a note in diligence. So when you buy a business, you kind of have a disclosure letter, and they popped a note in there that said there's an inquiry into a pension by HMRC. They've got everything they need. There is, we expect it to be completed soon, and we don't expect there to be anything of any interest. So I was like, okay, can you share the information relating to the pension? We got through information relating to, I think it's called the people's pension, kind of the bog standard pension. So there's nothing of any interest here. Pension payments were up to date. Everything was up to date. So we thought, okay, it is what it is. We expect it to be overseen, and we got an indemnity in the SPA, so not a problem. Moving forward, I had some friction with the FD quite quickly. Things didn't feel right. Things just didn't look right. Having worked with a number of, accountants in and out of businesses and FDs, they are generally very transparent. Here's the things, here's this, here's that. What do you need? What do you want? And I didn't ever get that from him, and it became quite challenging, to the point that we wanted to migrate from something, whatever it was, I can't remember what it's called now, to Xero. So I set up the account, sent the invite. We were using, I think it was Move My Books or something to move it all across. And that drags on for months. And then it was, actually, I haven't used yours. I've used my link, my login. So then I had to fight to get login access. It was just odd. Things weren't right. And it became a little bit fractious within the partnership, because I was kind of saying that something's up here. This isn't normal behaviour. But it was, you're being touchy and that kind of thing. Come to the end of the financial year, the day that our books were supposed to be, our annual accounts were supposed to be filed, I was in a taxi across London. They came through. I wasn't delighted with a couple of things, and because of the relationship I had, I wanted the sanity check, so I sent them off to an external accountant. Hadn't used the guy before. Just said, can you just have a quick look at these? I don't even think I looked at them. I was in a taxi. I've got a question about how the deferred is being shown and this and that. He had a look and said, I think you're right. Actually, I wouldn't reflect deferred in that way. Blah, blah, blah. And by the way, what's this? I said, I don't know. Went back to accountant. What's this line? And it was, I think it was listed as an unlisted investment, something like that. Nothing to see here, blah, blah, blah. Well, I need an answer. What is it? So back and forth a few times. He said, that relates to the HMRC investigation. How? What? And what had happened is, prior to completion, they'd said some things are going to be removed from the balance sheet. The FD, for context, is an external FD. So he was an accountant with his own accounting firm that was a consultant into the business and not an employee. So prior to completion, some things are going to be removed from the balance sheet, nothing to see here. Okay, fine. We had management accounts. We, of course, had board meetings. So for the nearly 12 months since, this stuff hadn't appeared on the balance sheet. As we went to submit the books, what a surprise, it appeared on the balance sheet. I was then obviously pushing, and I said to the guy that I'd sent it to, look, this has come up. What do I do here? Because the message from our internal accountant was, file them and we'll figure it out later. So we can't file accounts that aren't accurate, we don't know about, we don't, what is this? External guy said, absolutely not. Do not file. If you don't know, if you're not sure, take the hit on the fine, do whatever you got to do, but don't file. So over the next week or two, as you can imagine, kind of fires were blown up everywhere. And so I'm trying to get to the bottom of what has happened, what is going on, what was the investigation. And what had turned out is that 6 or 7 months before we completed, so seller had been using what was effectively deemed by HMRC to be a fraudulent pension scheme. There were movements with bank accounts in Liechtenstein, I think it was. There were shares of companies that were dormant, didn't exist, that were valued at hundreds of thousands of pounds, that were moved into pensions and then it was absolute insanity. The purpose of this scheme was to allow the business, to my understanding, was to allow the business to credit the director's loan account so that money could be taken out and corporation tax wasn't paid and income tax wasn't paid on these sums of money, effectively. This scheme had been used, what I now understand from research, this scheme had been used previously. The business had to settle with HMRC. It was the same or an identical or a very similar one. They then decided to use, again, the same or very similar one for 5 or 6 years further. So 6 or 7 months before we completed, HMRC launched what's called a COP8 fraud investigation. So this was March 21. We completed in December 21. So through March 21, they'd been liaising with HMRC, dealing with this fraud investigation. A few days before we completed, HMRC gave a protective assessment. So based on what we found, we think there is likely to be a loss of this amount. We're going to issue this assessment so we can't get timed out while we continue our investigation. The protective assessment was for directors' loan account credits being denied of 500,000 and additional corporation tax liability of 99,000 and something. And they were investigating further years. Through the year that this year that I didn't know about it, they had continued, seller and accountant had continued to liaise with HMRC. No, we don't have bank statements. Oh, I can't find this. I'm not sure about this. Effectively frustrating the investigation, shall we say. And at no point did they tell the owners about what was happening. It got to the point that the corporation tax liability was 677,000, I believe. And I think there were further years being investigated and £1 million of directors' loan account credits that have been denied. So it was a complete mess. And this had all been, none of this had been shared or told about. So that was the excitement. And when I found out about this scheme, so to your point about kind of what we learned and what we do differently, I think I did some things that are really quite helpful and things that have helped us since. So to cut a long story short, we found out about that and we said, look, we owe you this. While I'm not happy about this, we owe you this deferred, you owe the business this much money, or you owe this tax liability. Why don't we offset? You owe us a little bit more than that so we can set that up, but otherwise, let's just move on with our lives. He refused.
So did the business owner actually know this activity was going on? Was it the FD or did the business owner, was it they involved?
My understanding is that the business owner knew because we're in a legal process. So we're now going through disclosure. So I can see conversations. The business owner is saying they didn't, but like I said, we've got evidence to the contrary.
And like you say, they legally sign off the accounts anyway. So if they've been signing off accounts every year with this information on them, they're legally obliged anyway.
Yeah, and they knew the pension existed. They knew all of these things have been happening. when we did diligence, we said, is this the only pension? Yes, this is the only pension. Is there another pension for directors of mouse? No, there's not another pension. So all of these things they knew not to be true. They knew there was a fraud investigation on the go. They didn't share that. When they were liaising with HMRC through the year, didn't share any of that. So, whether or not I think it's implausible if you've got, £500,000 of director's loan account credits, you're potentially going to have to repay that you don't know about it. I don't. Especially when it's the same accountant that did his personal tax returns and things.
Yeah.
And when I spoke to said accountant about it and said other people, they were very clear that he was aware.
Right. Okay. So going back to what you learned from it then. So what was so they refused to offset initially?
Continue. So they absolutely refused to offset, which seemed to me to be the eminently sensible thing to do. We then said, well, we're not going to pay you your deferred. This is absolute insanity. We've got this incredible tax liability. We now, we bought the business to flip on. We can't sell it on with a huge investigation, with a massive tax liability, with likely more tax penalties to come. I can't sign a warranty that says, no, we're not going to find anything, because that doesn't seem to be the case. So we refused to pay any more deferred, effectively let them have the business back. And we're now in litigation for several million for the purchase price of the business, damages, lost profits, and all kinds of things. The hope, we offered to mediate. So we offered offset, that was denied. We offered 3-4 times to mediate, that was denied. We offered him the opportunity to lead the investigation with HMRC. We said, all you have to do is indemnify us. That was refused. So, the hope still is that it will mediate and we can sort it out. We'll be compensated and we can all move on. But absolute worst case, we've got a trial date for, I think it's this time next year. So it will go to trial.
Yeah.
And it'll be sorted out there.
But how has that been for you personally? Have you has this been a particularly stressful situation? Have you found it stressful or?
Yeah, of course. I mean, it's hideous. And when I found out about it as well, I think I was 5 months pregnant. So yeah, it's horrible, especially when from my perspective, it's so easy to resolve. Look, this has happened. Like I said, I don't love it, but also let's just offset and let's move on, and we can all go about our day. So, but every step, it was so irrational. Nothing made any sense. And to be honest, I still don't understand. Through this legal process, the defence has kind of come in, and there is no fraud, there was no investigation. And I'm like, this is just not true. So yeah, it's been stressful. I firmly believe the only people that win in litigation are lawyers. But in this case, the loss is significant, and there's potentially reputational damage as well that I'm not okay with. So we have to make sure that the record is set straight, that we didn't do anything wrong here, that we tried all reasonable steps. But if you can avoid high court, I would recommend it.
Yeah, definitely. So when you go back to the beginning, then obviously this fraud came out. I mean, do you think in hindsight there's something that you could have done differently to maybe find it earlier, or in DD? Do you think you could have found it in due diligence? Was there a way, or what do you think?
I think if people want to lie and they want to not tell you and they want to misrepresent, they're going to. So I've kind of, I've beaten myself up quite hard about this from time to time. Maybe I should have done this, that, and the other. But they were determined to keep this quiet. So I think our opportunity to find it were limited. When we say, is there another pension, and someone says no, I don't know where you go from that. I don't know what other question I'm supposed to have asked. We looked at the tax liabilities and stuff, and they weren't there. A couple of days before, the protective assessment landed, but again, that wasn't shared. So I think we maybe could have dug in a bit more, but prior to completion, I think there's very little we could have done. The answers were very clear. They were very short. I think post-completion, I think there was more that could and possibly should have been done to find it earlier, at least.
Yeah. So I can give a bit of guidance about how people could track changes, because it said it was in the balance sheet and then it was removed. So was it removed? Yeah. So when we do due diligence for people, when you look at a set of accounts, you have like the equity section at the bottom of the balance sheet, and you have the profit for the year, and then you have the retained earnings. So effectively what happens is, just for simplicity, is each year's profit, so the P&L only ever stays open for 12 months. And at the end of the year, you close your P&L down to zero, and it moves into retained earnings. So your retained earnings is effectively your consolidated profits and loss over a period of time in simple forms. Obviously, it can be other things like share premium, but let's just assume it's simple. So when you check the equity, the retained profits, that should always match. So this is the biggest problem we see with people where they don't put year-end changes in their systems. Theoretically, your system retained profit should always match the retained profit that's submitted to Companies House. If those numbers don't match, then there's a movement. That means someone's moved something, and it could highlight. And if it's big, if it's like small, like a couple of £100 or something, it can just be roundings. But if you're talking hundreds of thousands of pounds, then someone's made a change between the last set of accounts submitted to Companies House and what's on their finance system. Now, often people are just doing it out of naivety because they don't know, because the year-end accounts have been submitted and nobody's gone onto the system of Xero or QuickBooks and made the changes. But obviously some people could fraudulently change it. And it appears that that's probably happened in this case, or what it sounds like someone's gone and actively moved it to not hear it. But if you just do that quick check, it can help. If it was just a balance sheet movement, it might not be seen, but it can be a good checking point for people looking, because those numbers should match. And they're the biggest problems we see when we do finance DD, is they often when we see sets of accounts, they don't match. But like you say, the problem is if they don't match and the sellers can't give the detail behind it, which often they can't, then you're not really in any better position, because ultimately you have to choose whether to take the risk. But what they could do is help you find the situation sooner, because you would know that there's the problem, and that's what they have to focus on post-acquisition.
Yeah, thank you. I think the challenge that we had is that when the completion accounts were done, the item was removed, and that was okay with us. Whatever it is, cool. So our books from day one were quote unquote clean. It's just that this item then reappeared a year later. So we're like, well, where has this come from? What, you can't. So but I think it highlights, again, we had expert support, but if you don't get, or if you're not comfortable and familiar, get people to help you with diligence, especially in significant transactions. This was a multi-million-pound purchase. The risks are significant, and not everyone is playing with a straight bat.
Yeah, absolutely. So where are you now? Are you doing any acquisitions at the minute, or?
Yeah. It's been incredibly busy, actually. So the last couple of years, with everything kind of going up and down in terms of the economy and interest rates flying up, there's so much uncertainty around it. It's quite challenging to get purchases agreed. We've had a few offers accepted this year. We're looking into, we've got some transport purchases, looking at due diligence at the moment on a coach company, which is quite funny. A beauty service backed by software. I can't say too much, we haven't completed, but I'm quite excited with that one. What else is on the go? Lots of fun things on the go. And what I'm focusing on this at the minute is kind of building an internal team, so that, because like the challenge we spoke about before that every founder goes through, that I go through, I've called the founder's curse. And most of these things are kind of cookie cutter solutions. So we're just going to go in with the same team, solve the problems, pull the team out, and let the existing people run the business. So, high court trials aside, having a lot of fun, supporting some really great business owners. And I know I was speaking at a conference yesterday to a room full of women who are growing their businesses as well. So it's fun. I'm having a really nice time. My little lad, it's funny to think that I was 5 months pregnant when that came out. He's 7 months old now, I think. So time flies.
Yeah. I was talking about it because I was on a keynote talk myself when I was talking to a load of acquirers, and because my experience is, you're doing well with the acquisitions, because I probably speak to, I would say, at least about 30 buyers a month, probably, easily approach. All of them say to me, they're all quite excited because they all go, oh, I'm just about to get head to terms on a deal. Can we talk about whatever due diligence strategy, because they want to know what support they could have and things like that. And I would say realistically, probably out of every 30, probably only 2 successfully get to head to terms within a 6-month period, probably, of our conversation. And that just goes to show how hard the market is. And often that's because when they first approach, because they've got excited, because they've got this deal that's close to head to terms, typically that one that's close to head to terms doesn't actually go to head to terms, because something happens right at the end. Generally, the sellers change. Well, what I hear from the buyers is the sellers change the terms and they won't agree. I obviously don't know the truth because I don't know the conversations. I actually think the reality is they haven't had the right conversations. The right conversations in the beginning, which then led to the deal changing because one party feels like they're getting a bad deal because it's not the same terms as they agreed right at the beginning when they did the handshake agreement before they started to get the final documents in place, is my experience of what I see. So I don't know what you see, but that's what I see.
Yeah, I agree. I think the reason that I can get through so many now is, having made all those mistakes and learned from them, having kind of some of the uncomfortable conversations early. And you don't necessarily want to get too deep in the weeds, but what do you think about this, and what's your view on this, and kind of set your stall out before you waste too much time. I tend to have a few on the go at any one time, knowing that there's going to be quite a high fall-off rate potentially. You get people that change their mind, just panic at the last minute, and actually, I'm not ready to. Sometimes they change the terms. Sometimes they decide that they want a 10K a month consulting contract for the next year. All kinds of weird and wonderful things happen. People said in the business are just people, so things just happen. So try not to kind of have all my eggs in one basket and have some conversations, because I think, like you say, newbies potentially get quite excited. They invest a lot of time and a lot of money. They get to the end, it didn't get there, and they have to start again. So you've potentially spent 4, 5, 6 months just looking at this one thing, and it's quite tough. It's quite tough to get a deal done if you're going to if you can only really look at 2 in detail a year.
Yeah, well, I just want to say thanks so much for coming on, Kemi. It's been really great, and I think your experience is going to help a lot of people. So thanks for sharing your stories with us. I just want to say to our listeners, we're nearly at 5,000 downloads now. We're just under. So I just want to say thanks to everybody. And if you do love our show, hit the subscribe button because it helps more viewers find our channel. And I look forward to seeing you again soon.